because consumer demand is disappointing expectations. Inventories can build up very quickly when the consumer goes on strike. So inventory to sales ratios might be low right now, but they can go up very quickly when the consumer says no mas.
Cathie Wood, thank you so much for being here. It's great to see you.
Happy to be here, Kate, once again.
Yes, and it's been a busy conference day. You just sat down with Michael Saylor inside.
Yes, I did.
I want to talk about Bitcoin. We'll focus this conversation on Bitcoin and crypto. We'll talk about some of the macro stuff as well.
Yeah.
You've really become known for your contrarian views when it comes to equities. Is Bitcoin a contrarian investment at this point, or are you feeling like it's becoming more mainstream?
Well, we were the first public asset manager to gain exposure to Bitcoin in 2015 when it was $250. I think today it's $44,000, and we think it's just begun. But I don't think most institutional investors are positioned the way they ultimately will be. A lot of retail has really led the charge here. They, like with our other funds, the retail investor, the individual investor, those people with one foot in the new world, they get what we do. They get Bitcoin. So I think institutions are coming along slowly.
What are you seeing as far as the differences in retail investors in your ARK ETFs and some of the institutional investors when it comes to conversations about performance and long-term views and strategies? Talk about those differences.
Well, okay, so most of our investor base has been retail, but we have been cultivating institutional relationships for the past 3 to 5 years. We do have institutional investors, but so we have two conversations. For the retail investor who's been with us, who really does believe that we're onto something, that innovation is going to disrupt every sector out there, and they want to be on the right side of change, we have educated them. We have a 5-year investment time horizon. Everything we do, keep your eye on the prize, average down if you can, and usually that sort of disciplined behavior will work out over time. We often say time, not timing. In fact, one of our clients in Japan, Mizuho Fuke-san, that's his words. Those are his words. Time, not timing. And we have a chart now. If you held stocks instead of trading around them over time, you would have done much better than trying to time. So that's the retail base. So they're holders and they're averaging in. Institutions, in 2020 we had incredible performance. Innovation solves problems. COVID brought with it a lot of problems. And I think a lot of institutions looked at us like, what is this in terms of where does it fit into my matrix? And so we don't fit neatly into a matrix that any of these ratings agencies have or so forth. So I think we're being put into the alternative bucket. We're the closest to a venture capital fund in the public equity markets. And now they're looking carefully at us because of our research. The screen for our portfolios is not any benchmark. In fact, until recently, I didn't know what was in benchmarks. And I didn't know that of the 28% in technology in the S&P 500, we don't own any of them. We're very different. We're not backwards looking, we're forwards looking. And I think institutions are beginning to see the bifurcation between valuations in the private markets when it comes to innovation, which is where they are, and innovation in the public markets, and they're saying there's an arbitrage opportunity. So we're getting a lot more interest from institutions.
Got it.
Thank you for asking.
Of course. Well, as far as that 5-year horizon, year to date, you mentioned last year, of course, breakout year for ARK, performed very well during the pandemic.
2020.
2020. I know.
Yes.
What year is it? It's now 2022. But that era really was a time of outperformance for ARK. Underperforming now, how are you explaining that, and what are you thinking about ARK's underperformance, and how do you explain that to investors who might be worried about
Well, the investor who has been attracted to our strategies is a younger investor. I'll say it's across the spectrum, but the younger investors and the older investors who take us seriously about our 5-year investment time horizon, they're fine, because if you look at the past 5 years, we have outperformed NASDAQ, S&P, while I don't know what the number is, 75 to 80% of truly active managers have not. So we have that as a calling card, and we have a 5-year investment time horizon. We also give away our research. This is why we're investing in this space. And now we're playing more of a ground game, I would say. We're going to be publishing more of our models. So Tesla, we will put that update on GitHub next Monday, and we'll be tweeting, and our analysts will be doing videos so that our investors can understand the depth of knowledge that our analysts have, beyond the depth of knowledge, I think, of any other analysts in these technologies. The reason for that is we have organized our research teams by technology. There are 5 major platforms involving 14 technologies that are cutting across sectors. So they're technology specialists, and they are sector generalists. We think that's the right way to think about innovation. And I think that our investor base is reading our research, seeing the merit that it has, and they also understand how these innovation platforms are going to disrupt the investments in their base portfolios, their core portfolios. So they're using us at least for a hedge against those value traps.
So Cathie, you tweeted recently about the yield curve, so the difference between the 10-year Treasury and the 2-year yield.
Yes.
That inverted. So I'm reading from your tweet here, you say that is suggesting that the Fed is going to raise rates as growth and/or inflation surprise on the low side of expectations. You say it's a mistake and that the Fed is playing with fire. So what do you mean there?
What I mean is, when we saw the yield curve invert, and if you look at the 30-year to 2-year, it's a waterfall. It has come back a bit, steepened a little bit, partly because short rates have come down, which suggests to me that there are some people out there who might agree with us, who are saying, okay, the Fed, what's priced into the market right now is another 7 or 8 interest rate increases. That's priced in. And now they're saying we're going to be more aggressive than that. We'll go 50 basis points at a clip. We're going to get aggressive in terms of quantitative tightening, no longer quantitative easing. And so we're looking at consumer sentiment down at levels we have not seen since 08-09. Think about that. Record-breaking employment reports, record-breaking, unbelievably good. And yet the consumer is feeling terrible. 08, and no one's talking about this. You know, everyone who's saying, the economy's strong, the strong. No one's talking about a consumer sentiment. This is the University of Michigan Consumer Sentiment, suggesting that the consumer, which is 2/3 of our economy, is not happy and is actually depressed because their wage gains, income gains, are not keeping up with inflation. Their real income is dropping, and I think that the Fed has to watch out, because we see auto sales coming back down, and everyone says, oh, that's supply chain. We see furniture stores, big disappointments. Restoration Hardware is a good example. One retail industry after another is saying, whoa, something's happening here. But the headlines out there from a macro point of view are not picking up those micro signals, nor are they picking up the consumer sentiment surveys. So we're just looking at the facts, and we're looking at all of the data. And the final piece I'll add is, if you look at the inventory buildup that is taking place right now, partly because consumer demand is disappointing expectations, inventories can build up very quickly when the consumer goes on strike. So inventory to sales ratios might be low right now, but they can go up very quickly when the consumer says no mas.
And so as far as the inflation conversation, one of the debates out there is, could tech cause a deflationary environment,
Yes.
which has sort of been the long-term arc view.
Yes.
How do you square that with short-term inflation, things like you mentioned, higher sales, higher costs for consumers? Isn't that an inflationary environment? How would you explain that to somebody?
Yes, we've seen one supply shock after another. It went much further than I expected. I expected the supply chain bottlenecks after COVID to clear up in 6 months. It's been 2 years. All right, I didn't expect, we didn't expect Russia to invade Ukraine, which is the breadbasket of Europe. So, and it's the energy source for a lot of Europe. So those are 2 major shocks. I think Europe's in recession, and we can't think about the US in isolation. Europe's probably in recession. China is, if we're looking at the micro numbers, China's very weak, very, very weak. And so everything's riding on the US. So the supply shocks, I think, are hurting purchasing power, as I said, in the US, could cause a recession. That will unwind the supply chain bottlenecks pretty quickly. And I think a lot of what we're seeing right now is a function of supply chain and supply shocks, very cyclical as well. And I think we'll see the other side of that. And then, as you say, we're seeing powerful deflationary forces associated with technology. Artificial intelligence training costs alone, and this is going to involve every industry, are dropping, if you consider both hardware and software, 60% per year. That's just one example of the deflationary undercurrents in the global economy. And so I think longer term, we're going to see significant surprises on the low side of expectations when it comes to inflation. Now, in this conference, if you're a Bitcoin advocate, and we are, as you know, well, many people hold Bitcoin as an inflation hedge. I've just given you a deflationary story.
Right.
If we're right and deflation does happen, all of those companies who did not invest enough in innovation but leveraged up to deliver short-term profits, they manufactured earnings with lower share counts and they paid dividends, they're going to be in harm's way. They'll have to, in order to service their debt, they'll have to lower prices. So that's a part of the deflationary undertow we see out there as well.
Well, one of the undercurrents of this conversation too is the Fed and central banks.
Yes.
How does that affect Bitcoin and prices?
Well, again, many people think monetary policies around the world have been unhinged, especially since 08, 09. And they're seeing extreme increases in the monetary base, various monetary bases around the world. So Bitcoin is a hedge against inflation. Now, that will turn into inflation if the reserves on central bank balance sheets, which are the kindling for inflation, if they're lit. And that means if bank loans go crazy to the upside. We're seeing a share shift when it comes to loans into DeFi. So, there's a big, I think the banks have a big problem. They're losing talent to crypto, so they're having to raise wages to attract talent. And they're losing business to DeFi. Lending and saving, a lot of it is taking place in DeFi right now.
So ARK has had multiple breakout years during the pandemic. This year has been a little bit of a different story. The funds are underperforming. What are you telling investors who might be worried when they're looking at the price of some of your major ARK ETFs?
Sure. So I'll separate this into retail and institutional, although we think the lines are blurring here. It's very interesting that retail has been the early adopter of our strategies. And I think it's because individual investors see the ground shifting underneath. So underperformance. Anyone who's been with us for the past 5 years has outperformed, the S&P, NASDAQ, MSCI World, and we have always told our investors, 5-year investment time horizon, where the closest you'll find to a venture capital fund in the public equity markets. There is volatility, but truth will win out. So keep your eye on the prize. And they know this is the way the world is going. So we have had incredible asset retention, $17 billion in net inflows last year. We're inflowing this year as well. And I think that's surprised many people in the financial services industry. On the institutional side, we do have institutional investors. They have us in, they categorize us. We don't fit neatly into any matrix. So I think we're in the alternatives bucket. So the closest again to a venture capital fund. And they have been kicking the tires for the past 3 to 5 years. And now we're beginning to get flows from institutions. So they looked at 2020 and said, okay, this has gone too far. They look at what's happened, down 60% at one point since our peak. Again, we were up 360%, during COVID. Down 60%, they're saying, okay, compared to the valuations in the private markets for innovation, which have hardly budged at all, this is innovation in bargain basement territory. So we're getting institutional interest.
Very interesting.
Yeah.
I do want to ask you about regulation as well. Janet Yellen gave a speech about crypto earlier. We've seen some movement in Washington, D.C. when it comes to cryptocurrency, the executive order. What are you seeing as far as politics in Bitcoin and crypto? And is it bipartisan at this point?
Well, what we're seeing is 180 degrees different today than it was a year ago when Janet Yellen, it was roughly a year ago, Janet Yellen said, Bitcoin, environmental problems, illicit activity, money laundering, gambling, all of that. And you know, she just, door shut. And I remember I was asked at the time, and I basically said, she hasn't studied it. She hasn't studied the technology, and she hasn't studied the instrument, the new asset class. Well, it seems like she's been boning up because, again, just the other day, she focused on Bitcoin and crypto generally as, yeah, we need to make sure and encourage financial innovation. The US wants to lead, just as it has with many other innovation cycles. And I said to Yassine El-Mandra, our crypto analyst, I said, who's whispering in her ear? Because we began to hear other policymakers on both sides of the aisle talk in this way. And in talking to Michael Saylor earlier, he thinks it's Gary Gensler. Gary understands Bitcoin. He taught about it at MIT before he became chairman of the SEC, and he understands how profound this innovation is. First, global, private, meaning non-government, but it is open source, so public in that sense. Digital, rules-based monetary system ever. So it's a very big idea, and we do not want to be left behind.
And so Janet Yellen did her homework, or maybe heard from Gary Gensler.
I don't know who a lot of people heard on both sides of the aisle, because it's becoming a bipartisan issue, which is astonishing after the divide we've been witnessing over the last 8 to 10 years. And it's also becoming a single issue voting. A lot of people are just going to vote on this issue, and that's it. So we're getting politicians and policymakers coming up to us who want to run for office, and they say, can you help us pull together a group of crypto-minded people? I want to learn how I can make their lives easier. That's pretty astonishing.
Really
this is how they're going to be voted into office.
Wow. It's been interesting to see some of the attention out of DC. I want to ask you about a couple public names in ARK investments. We had Square, or now Block, announcing some big Bitcoin products. You mentioned on stage that the Lightning Network could add to demand for Bitcoin. What's your take on the impact of what Square is doing, or Cash App is doing, and what that could mean for Bitcoin prices?
Well, I think that Block's singular focus on Bitcoin is critical here. This is how Bitcoin's going to proliferate around the world. And the second layer solution, which is the Lightning Network on top of the base layer, has been in test mode for years now. And, one issue after another, but it seems as though the second layer solution has become more robust now and is ready for prime time. I think that was part of the announcement, direct deposit into the Lightning Network, taking away a lot of the friction in the user interface. So I think this could be big. Last year, Lightning, the number of channels on the Lightning Network almost tripled. I think a lot of that was El Salvador and maybe some of the other trouble spots around the world. This is going to bring the US, I think. I think the number of channels is going to explode, and my guess is the number of developers developing to this platform is also going to explode.
I want to ask you about Coinbase, another big ARK investment, and sort of a proxy for some people for Bitcoin investing. Jim Chanos was on our air talking about shorting Coinbase and some of his reasoning. The big one was fee compression and the idea that Coinbase might be over-earning. Do you have any fears about margin compression when it comes to some of the Bitcoin brokerage firms?
So we are assuming significant fee compression, both on the institutional and the retail side. So that's no surprise. It's baked into our model. What Coinbase for us is, it's a crypto asset play, and it's institutional and retail, so it could be a digital wallet. We're looking for who are the winners in the digital wallet space. Is it Cash App? Is it Coinbase? Is it Robinhood? And they're all in the running, and they're coming at it from different angles. And you've got the institutional side of crypto, and we believe that institutions, their go-to, the first, is Coinbase. It's the most robust platform, and it's got the most liquidity on it. And so we think the scaling opportunities, given what we think is going to happen to Bitcoin. Now, as you may know, Bitcoin today is around 44,000 per Bitcoin. We see that scaling to $1 million by 2030 or more for all kinds of reasons, not just store of value, not just the payments, what do you call those?
Cross-border payments?
Cross-border payments, but remittances,
yeah.
not just that. But institutional investors, insurance policies that high net worth individuals take out so that their wealth won't be confiscated, like we're seeing more and more often these days, and a substitute for money in emerging markets where they can't trust their monetary regimes or their fiscal regimes. So we see an incredible number of use cases, and we think Bitcoin will be leading the charge in many of them.
And Cathie, we'll let you go in a minute. I do want to ask you about PayPal. ARK sold out of PayPal. Do you think they have a chance here to become one of those apps and single money apps that fintechs have talked about? Why did ARK decide to get out?
So we owned PayPal, very focused on Venmo, perhaps becoming the digital wallet. And it will be in the running. But I think the way Cash App is growing organically, as opposed to more of a top-down, let's get this thing moving, stretch. I think there's an organic movement. I think it's going to be fired up now by Bitcoin. Now, of course, Venmo is accommodating Bitcoin as well, but it's more of a follower of Cash App, and so we tend to put our bets with who we believe will be the winners. And as we were consolidating our portfolios during the last year, we had a whole year to consolidate our portfolios during the risk-off period for innovation, consolidating towards our highest conviction names, we made some choices, and we chose Block over PayPal.
The last thing I want to ask you is about the macro picture. So we've seen Bitcoin really trade in line with NASDAQ and some of the high-growth tech stocks. When do you think that will decouple, and why isn't it really trading like some sort of hedge?
Well, I think, if you look at the activity within Bitcoin, you'll see the percentage of long-term holders is roughly 70%, so 13.5 million Bitcoin out of the 19 out there. So long-term, 70%. And that is very different behavior from what we're seeing in the equity markets. Bunch of high-frequency trading, short-term holders. They're doing timing, not time, and we think that's a mistake, long run. So I think when we move out of this period of downside volatility, we think the private market valuations are more correct than the public market valuations, and that there will be a closing of that gap in here. I think the time horizons will lengthen. That's what always happens in risk on. Now the time horizons have collapsed. So it's just an equity versus Bitcoin ethos right now.